How did assets perform last year, and what does that mean for investors? To share his insights, Grant Patterson joins us now. He's from Providence Wealth. Grant, great to see you. And,
thanks, Carl.
Really appreciate you coming up and visiting in the desk. It's always nice. But, I had to sort of actually check myself a little bit on Friday because, of course, we're all caught in this year that was kind of mentality with the end of the financial year. Australian equities, up 9.5% over the last 12 months. Perhaps surprising to some. Did it surprise you too, the performance, the strength?
Well, certainly it did surprise us, the strength in equity markets generally, around the globe, particularly the last quarter, which was really powered by obviously the tech stocks, and then the rest of the market got dragged along, if you like, with it. The Australian equity market did lag the overseas markets last year, so sort of left behind probably because of the banks, which we think will continue. But overall, a very positive year, given cash rate during the year. The average cash rate in Australia was 2.9. Looks like balanced super funds will come in around 8 or 9%, 7 to 9%. So yeah, pretty strong year, and very, very strong in equities, particularly, as you know, in a small number of stocks on the NASDAQ and in the S&P.
Because I'm a simple man, of course, and I try and go through history to see sort of comparable periods of time, which might sort of reflect how much of a drawdown is experienced through different sort of recessionary periods or rate hiking cycles. And typically it's 25-30%. Obviously we have catastrophes where it can be much higher, but we've sort of already experienced that, at least on Wall Street, for example. So with equities picking up, especially in the United States over the last 6 months, do you get the sense that maybe we're past the worst of it, or is it too soon to run victory laps?
It might surprise you, but I've been around markets a lot longer than you have.
Indeed.
And the big question is whether this rally is justified, obviously. And you can have very strong bear market rallies, which is not uncommon, and this is, I think, a very strong rally. The question is, do the fundamentals really support the current rally? Now, we have a macro bearish view of global economies. We do believe that a recession is likely here in Australia and overseas because of the aggressive raising of interest rates, which we haven't seen before, in so steep so quickly. The collapse of money supply, which has fallen off a cliff. So macro, we're quite negative. But if you look underneath the surface of an index, for example, there is some opportunity starting to show themselves, which have been left behind. So, for example, in the US market, we think the index is quite high. It's expensive, trading on a PE of 20. If you take out the top 10 stocks, the market's trading on a PE of about 16. If you look at the median stock, it's trading on a PE of 14. And 30% of the market in the States is trading on a PE of less than 10. So I think it's really important in this sort of time when there's a lot of volatility to look through the headlines and try and pick out the gems that might be just being left behind in all the hype.
So how do you go about that personally? Because of course you sort of taken a bit of a top-down approach there to sort of suggest that maybe valuations and therefore risk-reward is fairly attractive. But I guess there's that macro overlay of where we are in the economic cycle. So is there any sort of pointers or any sort of way that you frame your thinking when you're trying to find what might be an appropriate investment given the context?
Well, we have a view that valuations do matter in the end run. So we try and dig below the surface to see if those companies or that asset class can withstand a slower economy or a recession. Will the cash flows hold up during that period of time? Is their balance sheet in reasonable shape? And it doesn't matter what asset it is, that's what we look to. So, you're seeing now in like the US commercial securities and offices, huge falls there. And that's not over yet. There's $900 billion worth of refinancing to come up in that sector. So it's too early for us in that area. But as I mentioned before, some of the small to mid-cap companies are trading on very attractive PEs, both in the States and particularly in Europe. So we really just have to look behind the noise of the macro. Quite frankly, we don't know where inflation's going to settle. I'm not quite sure how hard the Fed will keep going. We're towards the top of the cycle, so that's a positive. And there's some stress now coming out of the system, or some stress in the system, and that's when some attractive assets will show themselves.
So, if There was a theme in 2022, the calendar year 2022, of course. It's, this whole notion that there was really nowhere to hide. Diversification was increasingly difficult, especially as liquidity was removed from the market. I mean, government bonds, they were, in principle, a defensive part of the portfolio. I mean, how did you find their performance, and how do you see their relative attraction right now with where we are again in the cycle?
Yeah, well, look, very volatile. I mean, the volatility in the defensive secure asset price was quite amazing, and that was the markets whipsawing between, recession and growth staying higher than what they had expected. We're starting to increase our duration in portfolios. So we believe, given the macro risks out there, that a bit more duration in the portfolio is warranted. We're very underweight bonds, and we're starting to look at global bonds to put into the portfolio just to protect us in case there is this sort of slowdown, which really the market's not really factoring in. I mean, earnings growth is still quite strong in most forecasts, but interestingly, the bond market has a different view. The yield curve is quite inverted, and that's normally a fairly accurate indicator of slower growth and potentially recessions down the track. And if that occurs, then bonds will definitely have a place in the portfolios.
Okay, indeed. So what about Australia, given this sort of high interest rate environment, especially considering we're so sensitive both from a cash flow point of view but also wealth point of view to the housing sector?
Well, I mean, we are more leveraged to the rise in interest rates than most other economies because of the high household debt and because of our housing market. So that does worry us, and Philip Lowe's given every indication that he's going to continue to increase rates at the short term. So there's a lot of pain out there at the real level, at the household level, and even with company earnings as well. I mean, there's some embedded wage costs growth now in the market for the next 2 or 3 years. So margins and earnings growth is going to come under a bit of pressure, and then the banking sector we think will struggle in that sort of environment. So I think it's going to be a pretty difficult period of time as households readjust to the higher interest rate cycle that's continuing to come through.
So with all that said, I mean, the assets that you're most comfortable with and those you would avoid, are there any sort of ideas there in particular?
Well, we are investing in a global fund manager for distressed credit, because we believe over the next year or two there's going to be some opportunities where credit or loans trade at a discount, given the lack of money supply and the lack of capital, particularly in the US regional banks that have faltered. So we're looking at that. We're also quite keen on adding duration to the portfolios, which is through global credit. In equities, very much mid-cap, small-cap as a preference for value. The Japanese equity market looks quite structurally interesting with the rise of activism and releasing capital from balance sheets, so we like that. We're still invested in niche direct property, regional hospitality, agriculture, that sort of sector, but we're not in the commercial sort of area, as I mentioned, in office. And so that, and on a relative basis, we would be underweight the Australian equity market compared to the opportunities that we see on a global basis.
Interesting. One final question, and just only ask because I'm sure a lot of our viewers, but just in general as well, for those who are sort of obviously in a certain stage of life and obviously looking to sort of protect their wealth at the very least through this environment, hopefully obviously continue to grow it as well. Just the outlook for balanced funds in the year ahead. Do you have a view on that? Well,
it's very hard to know. It's a very difficult investment environment to really get clarity about how this is going to pan out. So if it's all about protection and preservation of capital, I think the most important thing at this stage of the cycle, in my experience, is to remain very diversified, have some defensive assets in your portfolio, like we've got gold in the portfolio, for example. I think this is a time for active management, not for passive, because you need to pick your way through the valuations area. And I think, in a higher interest rate environment, income's going to be enhanced. You're going to get more income out of your portfolio. So, we'd be looking for sort of, subdued returns, single digits, but, a reasonable level above cash. But I think we're going to see still quite a lot of volatility over the year ahead, and that's why you want the diversification in your portfolios.